Let's see how to analyze any stock in 10 seconds. So here we are on ValueGlance.com looking at Netflix. Quality, good quality company. Value, overvalued. Okay, that's just a trim, not a buying opportunity. So what did we do here? We wanted to ask, is Netflix a high quality business that's creating long-term value? And is it in bubble territory or is it at a reasonable historical price? And so that's what the quality and value trading quadrant does for us. So in ValueGlance, we have the data visualization feature where we can look at long-term trends, not what happened yesterday, not what happened last quarter, but these long-term trends over time. If we want to compare those key metrics based on quality and value, we can click on these buttons over here. And what we notice, it lights up and shades the area between these two curves. And so when we click on quality, we see the ROIC in blue and the cost of capital in orange, and this green region here shaded. What we'll notice is this also lights up half of the trading quadrant. We see the good quality side is lit up because this condition is satisfied. ROIC is above WACC, the cost of capital. So we're creating long-term value. If we were to click on a different point, for example, back in 2016, we can click on that, June 2016. We see the quadrant updates here, June 2016, and it hops over to this side, bad quality, because in this case, the ROIC is below the cost of capital. Now we see a bad quality company, that's a sell and that's a sell, independent of whatever the price is. If you have a business that's destroying value over the long term, maybe you don't want to own that business. Now, that's one particular strategy, but it is a simple way of getting the most out of this ROIC metric. So that's quality. What about value? So we click on value and we see the hype factor here in green and then the equilibrium hype in purple. And we notice we're evaluating now at June 2016, so the latest, back in 2016. And so we see if we click on a later point here, let's say March 2025, we notice this is overvalued because Q, the hype factor, is above Q star, this long-term median equilibrium value. And so we see that the bottom half is lit up. And so that's either trim or sell depending on quality. And so now if we were to put quality and value together, we see that we're lighting up the good quality and overvalued parts of the trading quadrant. And so that's a recommendation there, trim. Of course, don't take this as a final answer. Use it as a starting point, a framework, if you don't know where to begin in your analysis. Saying, okay, this is a good quality company, but compared to its historical valuations, it may be a little too expensive. If we were to click on another time, so for example, going back to here, let's say 2022. So back in 2022, we see the company was good quality and undervalued in this case. And so that could have been a good buying opportunity. So how would that have done? So if we go down here and click on price, we see, yes, there was a crash in price and the hype factor crashed down. And so if we were to get in 2022, even 2023, while we were still undervalued, you could see we would have had great returns buying Netflix. So that's one example where the strategy works quite nicely. But the point here is just to use the trading quadrant as a first pass, as a starting point to say, is this a high quality business? Is it in bubble territory? Or is it at a reasonable historical price?